I was reading an Atlantic article titled "The Job Market is Hell," and it really stuck with me. The subheader summed it up perfectly. Young people are using ChatGPT to write their applications. HR is using AI to read them. No one is getting hired. It's a strange but very real situation. On one level, it's almost funny. Everyone is using AI, so nobody really gets an edge, kind of like Formula One, where all the teams upgrade their cars at the same time. But the bigger point is much more serious. AI could cause real disruption in white-collar jobs, the very roles that used to be seen as safe. The chart shows how the adoption of AI is still surprisingly low. Less than 15% of companies use it right now. But investment in AI infrastructure is skyrocketing. For example, Oracle expects its cloud revenue to grow nearly eightfold by 2030, and companies are building massive data centers that consume power on the scale of nuclear plants. These numbers are staggering, and they highlight just how quickly AI is scaling. The takeaway is that AI isn't just another tool, it's becoming a central factor in the economy. It's reshaping the job market and will play a huge role in future macroeconomic trends and investment strategies. I came across this Bloomberg opinion piece by Guy Spier called "The Golden Age of Value Investing is Over." He basically says that value investing just isn't the same anymore. Back in the day, you could actually get an edge just by having better access to company reports or by attending events in person. Now with the internet, and especially with AI like ChatGPT, all that information is instantly available and easy to process. So the advantage of doing deep research has really shrunk. His conclusion is that the real winners going forward will be index funds, giants like BlackRock that run them, and investors who can leverage strong personal networks, because that's one area where AI can't compete. The article explores how AI is changing investing, but argues that it doesn't make traditional strategies obsolete. AI has been used in investing for decades, with studies showing impressive results. For example, one 2016 study found AI models outperforming the S&P 500 by 18% annually over a 20-year period. More recent research confirms that AI can improve prediction accuracy dramatically. However, the author emphasizes that AI can only analyze existing data. It cannot predict future macroeconomic events, interest rate changes, or human behavior. This means opportunities still exist for investors who understand cycles, psychology, and business fundamentals. The author references Robert Shiller's work, which showed that stock prices fluctuate more than dividends alone would suggest due to investor psychology. This inefficiency creates chances to beat the market, especially when patient investors buy undervalued stocks during periods of irrational fear. Historical examples include the pandemic-era mispricing of companies like ExxonMobil, which was unfairly discounted while tech and EV stocks surged. Once economic fundamentals reasserted themselves, oil and energy stocks rebounded. Today's market, while top-heavy and heavily influenced by AI tailwinds, is not fundamentally different. Large tech and AI-focused companies dominate the index, but their infrastructure relies on smaller firms that can benefit disproportionately if capital rotates into undervalued areas. Cyclical industries, like industrials, energy, and housing, remain areas where patient investors can generate alpha by buying during periods of weak growth expectations. The author cites metrics like the ISM Manufacturing Index and industrial to S&P 500 ratios as tools to time these opportunities. Specific examples include Old Dominion Freight Line and Union Pacific, both high-quality, wide-moat companies temporarily depressed due to cyclical weakness. By focusing on business cycles rather than predicting breakthroughs, the author builds long-term positions in companies that are likely to outperform over time. He argues that AI will mostly affect short-term trading and event-driven strategies, pushing more investors toward passive funds and making markets more predictable in the short term. Yet, irrational market behavior around cycle turning points ensures that disciplined, cycle-focused investors can still outperform. AI is disruptive and democratizes data, but it cannot replace long-term, cycle-aware investing. Focusing on high-quality cyclical opportunities offers substantial alpha potential, and the current market with rate cuts, AI tailwinds, and a top-heavy index presents a favorable risk-reward for rotation into undervalued sectors. The main risks are mistiming cycles or selecting companies that fail to capitalize on the recovery, But the author remains confident that careful, long-term strategies will continue to generate strong returns. Thanks for watching. See you in the next one.